Many of our basic types of taxes, sales tax, property tax, income tax, even tariffs, have been around for over 5,000 years. In ancient Egypt, before they were even using coined currency, the pharaoh would collect a 20% tax on all grain harvested. Julius Caesar implemented the first sales tax. Caesar Augustus instituted direct income tax. The Magna Carta introduced a revolutionary concept that the king couldn't levy new taxes without the consent of the government in 1215 AD. Taxes have been a cornerstone of governance and public finance throughout U.S. history, evolving to meet the changing needs of the nation. From their origins in the colonial period to their modern complexities, taxes reflect political, economic, and social changes in each era. Here is a timeline of the history of taxes in the United States, focusing on key events, key developments, and key legislature. Colonial governments implemented taxes to fund local administration and defense. Common taxes included property taxes, which was based on land or personal wealth, poll taxes, a tax levied per individual, and excise taxes levied on goods such as tobacco, liquor, and imports. These navigation acts imposed duties on goods traded between the colonists and other nations to favor Britain merchandise and control colonial trade. So the Molasses Act of 1733 imposed a tax on all imported molasses, sugar, and rum, and it was designed to protect the British West Indies plantations from French and Dutch competition. During the French and Indian War, the British government accrued significant debt, and to recoup these costs, they began taxing American colonists more aggressively, and this was not sitting well. After the French and Indian War, the British ended the policy of salutary neglect, which was a lenient enforcement of trade regulations, to enforce stricter taxation policies to make more money. The Sugar Act in 1764 reduced the tax on molasses, but enforced it very rigorously, hurting colonial merchants. This really marked the beginning of the heightened colonial resentment against British taxation policies. The Stamp Act in 1765 required colonists to purchase stamped papers for legal documents, newspapers, and playing cards. This sparked widespread boycotts and protests. The slogan, "No taxation without representation," emerged from this. The Declaratory Act in 1766 repealed the Stamp Act, but it reaffirmed Britain's right to tax and legislate the colonists in all cases whatsoever. The Townshend Acts in 1767 taxed imports on glass, paint, paper, and tea, and colonial opposition to this led to renewed boycotts and renewed protests. In 1770, though, all of these taxes would be repealed except the tax on tea. The Tea Act in 1773 allowed the British East Indian Company to sell tea directly to the colonist, undercutting local merchants but maintaining the tea tax. This resulted in the famous Boston Tea Party, where colonists dumped tea into the Boston Harbor as a form of protest. The Coercive Acts, also known as the Intolerable Acts of 1774, were passed in response to the Boston Tea Party, and these laws included the Boston Port Act, which closed the harbor until the tea was paid for, and it tightened British control over the colonies. When the Revolutionary War began in 1775, taxation grievances really fueled the revolutionary sentiment, leading to the outbreak of the war. The Declaration of Independence in 1776 listed taxation without consent as one of the main grievances against King George III. When the U.S. Constitution was adopted in 1787, Article 1, Section 8 granted Congress the power to levy taxes, duties, and excise to pay the debts and to provide for the common defense and the general welfare of the United States. Article 1, Section 9 required direct taxes, such as property taxes, to be appointed among states based on population. During this time, tariffs on imports were the primary federal revenue source. The whiskey excise tax in 1791 is going to be the first federal excise tax applied to distilled spirits to fund the national debt from the Revolutionary War. Western farmers, who often distilled surpluses of grain into whiskey, really opposed this tax. This tax would lead to the Whiskey Rebellion in 1794, where protests in western Pennsylvania would escalate into an armed insurrection. President George Washington would have to lead troops to suppress the rebellion, demonstrating federal authority to collect taxes. The direct tax of 1798 levied taxes on houses, land, and slaves during tensions with France during the Quasi-War. This tax was very controversial, and resistance peaked with events like the Fry's Rebellion in Pennsylvania from 1799 to 1800. Under President Thomas Jefferson in 1802, most internal taxes were eliminated, and the federal government relied on tariffs and land sales for revenue. The War of 1812 would increase the need for federal revenue, so Congress would enact some temporary taxes. They would put excise taxes on goods such as sugar, carriages, and distilled spirits, and they would increase custom tariffs. After the war, 1718, Congress would repeal most of these internal taxes, relying again on tariffs as the main revenue source. In 1828, tariffs are going to be raised, and this was to protect northern industries, but this angered southern states who relied on imported goods. This is going to spark some tension between the North and the South, as southern leaders like John C. Calhoun are going to argue that tariffs are unconstitutional. The nullification crisis from 1832 to 1833 is going to be when South Carolina is going to declare federal tariffs are null and void, threatening secession. Bet we're going to hear about that again from South Carolina one of these days. This crisis will be resolved with a compromise tariff in 1833. In 1846, the Walker Tariff is going to be introduced. It's going to be introduced under President James Polk, and this tariff significantly reduced rate to prominent trade. This marked a shift towards more free trade-oriented policies, especially benefiting agricultural exports. In the 1850s, before the Civil War happened, some things were being debated when it came to taxes. Federal revenue remained heavily dependent on tariffs during this period. Southern states increasingly opposed the high tariffs, arguing that they disproportionately benefited northern manufacturing at the expense of southern agriculture. And calls for tax reform became tied to a broader sectionalism tension leading up to the Civil War. The Revenue Act of 1861 is going to be signed on August 5th, 1861, and it is going to introduce the first federal income tax in U.S. history. It is going to tax incomes over $800 at a flat rate of 3%. Even though this tax was introduced by law, it lacked an efficient system of collection, so it really had limited revenue generation. The Revenue Act of 1862, passed on July 1st, would overhaul the tax system. It would introduce a progressive income tax with 3% on incomes between $600 and $10,000 and a 5% tax on incomes over $10,000. This act created the Office of the Commissioner of Internal Revenue, the predecessor to the IRS, to oversee tax collection. It levied excise taxes on goods such as tobacco, alcohol, playing cards, and even luxury items. It imposed new estate taxes and taxes on corporations, including dividends and interest. In 1863, with Union war expenses going up, additional taxes were placed on consumer goods, licenses, professions, nearly affecting every aspect of daily life. The Revenue Act of 1864, passed on June 30th, would increase tax rates yet again. So there would be a 5% income tax on all income between $600 and $5,000, which is $12,000 to $100,000 today. There would be a 7.5% tax on incomes between $5,000 and $10,000, which is $100,000 to about $200,000 today. And then there would be a 10% tax on incomes over $10,000, which today would be over $200,000. The Revenue Act of 1864 also strengthened the enforcement measures to be able to actually collect all the taxes. This act in 1864 increased federal revenue, making income taxes a cornerstone of union financing. In 1865, the war is going to end, but the taxes are going to remain. By the end of the war, income taxes and excise taxes had generated substantial revenue, contributing to the Union's victory. Because the total revenue increased dramatically during the war, the government did not want to get rid of all the taxes, so they kept most of them. In 1894, the Wilson-Gorman Tariff Act would be passed. This introduced the first peacetime federal income tax to reduce the dependency on tariffs and address economic inequality. This levied a 2% tax on incomes over $4,000. But in 1895, the Supreme Court is going to strike down the tax. In Pollock versus Farmers Loan and Trust, the Supreme Court is going to rule that the income tax was unconstitutional as it was a direct tax not apportioned among the states. 1909, President Howard Taft is going to push for a constitutional amendment to allow Congress to levy income taxes without apportionment. In 1913, the 16th Amendment is going to be ratified, and this is going to give Congress the explicit authority to levy federal income taxes, paving a way for the new modern tax system. The Revenue Act of 1913 is going to change some things. It is going to reintroduce the federal income tax at a progressive rate, 1% on incomes over $3,000, $4,000 for married couples, and surtaxes of up to 6% on incomes exceeding $500,000. The Revenue Act of 1913 would reduce reliance on tariffs and align with the progressive era goals of reducing inequalities and promoting fairness. The Revenue Act of 1916 is going to increase the income tax rate and introduce estate taxes to address wealth concentration and prepare for potential U.S. involvement in World War I. In 1917, the United States is going to officially enter World War I, and to finance this war, Congress is going to significantly raise income tax rates, and they're going to introduce new taxes on corporate profits and excess business earnings. The Revenue Tax of 1918 is going to be enacted to meet the costs of World War I. In this act, the top tax rate is going to increase to 77% for those earning over $1 million. It is going to broaden the base of taxpayers, making income tax a major source of federal revenue. And it's going to introduce taxes on luxury goods and excess corporate profits. After World War I, the federal government would begin rolling back some of these wartime tax measures, but the income tax remained a permanent fixture in the tax system. The Revenue Act of 1932 is going to be passed under President Herbert Hoover during the Great Depression. This act is going to raise the rate of income taxes. The top rate increased from 25% to 63% and introduced new excise taxes on items such as gasoline and luxury goods. These taxes intended to address falling federal revenue and mounting deficits. In 1935, the Social Security Act would be passed, establishing the Social Security program, creating the first payroll taxes. This funded retirement pensions and unemployment insurance through employers and employee contributions. The Revenue Act of 1937 would focus on closing loopholes and improving tax compliance for high-income individuals and corporations. The Revenue Act of 1939 would simplify tax code and establish the Internal Revenue Code, consolidating existing tax laws. The Revenue Act of 1940 would increase individual and corporate income tax rates, and this expanded the tax base by lowering exemptions, bringing more Americans into the tax system. The Revenue Act of 1941 would raise taxes further to fund defense spending as the United States was entering World War II. The top income rate would go up to 81%. The Revenue Act of 1942 marked a dynamic expansion of federal taxation. It included a victory tax, a 5% surcharge on all individual incomes. It further lowered exemptions, making income tax a mass tax for the first time. Approximately 10% of Americans paid income taxes before the war, and by the end of the war, it rose to 90%. It also raised the top income tax rate to 80%. The Revenue Act of 1942 also introduced deductions for medical expenses and other allowances. In 1943, the Current Tax Payment Act would be passed. This established withholding taxes requiring employers to deduct income taxes directly from workers' paychecks. This simplified tax collection and ensured a steady government revenue. The Individual Income Tax Act of 1944 introduced a modern concept of tax brackets. It created the standard deduction, simplifying tax filings for many Americans. In 1945, post-war taxation increased. The top income tax rate peaked at 94% for incomes over $200,000 to fund the war effort. Federal tax revenues reached unprecedented levels, covering nearly half of the wartime expenses. The remainder was funded through war bonds. The Revenue Act of 1945, which was actually established in 1946, would reduce the income tax rates slightly, but kept them high to continue to cover the war debt. The top tax rate was lowered from 94% to 86.45% for incomes over $200,000. The Revenue Act of 1950 reintroduced corporate and excise taxes to fund the Korean War. The Internal Revenue Code of 1954 was a comprehensive revision and simplification of the tax code. It introduced tax deductions for medical expenses, and it made changes to the depreciation rules for businesses. The Revenue Act of 1962 introduced the investment tax credit to encourage businesses to invest their money. This would be the first major tax reform under President John F. Kennedy. The Revenue Act of 1964, known as the Kennedy Tax Cuts, would be proposed by President Kennedy but enacted by President Lyndon B. Johnson. This cut individual tax rates. It reduced the top rate from 91% to 70%, and it lowered the lowest rate from 20% to 14%. This stimulated economic growth by increasing disposable income and increasing consumer spending. The Tax Reform Act of 1969 introduced the Alternative Minimum Tax, the AMT, and this was to prevent high-income taxpayers from avoiding taxes through excess deductions. The Revenue Act of 1971 established new tax credits for businesses and low-income individuals. This was a response to economic challenges, including inflation and unemployment. The Tax Reform Act of 1976 increased estate taxes to address concerns about wealth inequality. And the Revenue Act of 1978 reduced the maximum capital gains tax from 49% to 28%. It expanded tax incentives for retirement savings through the creation of IRAs, which are individual retirement accounts. In 1981, the Economic Recovery Tax Act is going to be passed. It will be signed into law by President Ronald Reagan, and it was one of the largest tax cuts in U.S. history. It lowered the top individual tax rate from 70% to 50%, and it also reduced corporate tax rates and introduced an accelerated depreciation rule to encourage business investments. In 1982, the Tax Equity and Fiscal Responsibility Act is going to be passed. It's going to reverse some of the Economic Recovery Tax Act's tax cuts due to mounting federal deficits. The Tax Reform Act of 1986 is going to be a landmark legislation that simplified the tax code and broadened the tax base. It reduced the number of tax brackets for individuals from 15 to 2, a 15% bracket and a 28% bracket. It cut the corporate tax rate, the top corporate tax rate, from 46% to 34%, and it eliminated or reduced many deductions and tax shelters to ensure fairness and revenue neutrality. The Omnibus Budget Reconciliation Act of 1990 was signed into law by President George H.W. Bush, and it raised the top individual income tax rate to 31%. It also introduced new taxes on items such as yachts and cars. The Omnibus Budget Reconciliation Act of 1993 was signed into law by President Bill Clinton, and it increased the top tax rate for top earners to 39.6%. It also increased corporate tax rates for large companies. The Tax Relief Act of 1997 would reduce the capital gains tax from 28% to 20%. It would also establish the child tax credit and create educational tax incentives, such as the Hope Scholarship and the Lifetime Learning Credits. In 2001, the Economic Growth and Tax Relief Reconciliation Act would be passed. It would be signed into law by President George W. Bush, and it would lower income tax rates across all brackets. It introduced a new 10% tax bracket for the lowest income earners, and it also increased the child tax credit and allowed for higher contributions into retirement accounts. The Jobs and Growth Tax Relief Reconciliation Act of 2003 accelerated the tax cuts from the 2001 Act, and it reduced the top rate on dividends and capital gains to 15%. In 2008, the Economic Stimulus Act is going to be passed, and this is in response to the recession. It provided tax rebates for individuals and businesses. It also increased the standard deduction and offered incentives for homebuyers. In 2010, the Tax Relief, Unemployment Insurance, Reauthorization, and Jobs Creation Act is going to be passed. This is going to temporarily extend the Bush-era tax cuts and reduce the payroll taxes by 2%. In 2013, the American Taxpayer Relief Act of 2012 will be passed, and this made Bush-era tax cuts permanent for individuals earning less than $400,000 and couples earning less than $450,000. This raised the top income tax rate to 39.6% for high-income earners. In 2017, the Tax Cut and Jobs Act is going to be passed. It will be signed by President Donald Trump, and this act was the most significant overhaul of the tax code since 1986. It is going to reduce the corporate tax rate from 35% to 21%. It lowered individual tax rates across most brackets and increased the standard deduction. In 2020, the CARES Act is going to be passed, which is the Coronavirus Aid, Relief, and Economic Stimulus Act. This is going to provide economic relief during the COVID-19 pandemic. Included in this were direct payments to individuals, which were the stimulus checks, and expanded unemployment benefits. This also allowed businesses to carry back losses and delayed payroll tax payments. In 2001, the American Rescue Plan Act is going to be passed and signed by President Joe Biden. This act is going to expand the child tax credit, making it fully refundable and increasing the maximum tax credit amount. It is also going to provide additional direct payments to individuals and expand earned income tax credit benefits. And in 2022, the Inflation Reduction Act is going to be passed. It introduced new revenue-raising measures, including a 15% minimum corporate tax on companies with $1 billion or more in profits, and a 1% excise tax on corporate stock buybacks. Taxes have been a crucial part of the United States history, shaping its government, its economy, and its society. From colonial grievances over taxation without representation to modern debates about fairness and economic growth, the evolution of taxation reflects the nation's priorities and challenges at different times. So here are some questions to think about now that I've dived into taxes and tax law and tax acts and all this stuff. How should taxes be distributed among income groups? Should federal and state taxes be a flat tax or by income? What role should corporations play in funding public programs? And how can the system remain simple yet effective? Let me know your thoughts in the comments. Goods such as tobacco,